A lot of cross currents in today's trade, and of course that includes Facebook. We got the U.S. Federal Reserve this week. We have the President of the United States and his latest tweets. Let's talk about it, break it down with Diana Avigdor, Portfolio Manager and Head of Trading with Barometer Capital Management. Always good to see you, Diana.
Thank you very much for having me.
All right, let's start with Facebook. We know that a lot of money managers were concerned last year, although we were all making money if we were along the market. Pretty heavy concentration in those FANG names, including Facebook. Now we have some trouble. How much can we blame today's weak start to the trading week on Facebook and what they're doing with our information?
For sure, Facebook being down 7% is a bit of a problem. We can see the volume very elevated in the stock, whereas the volume in the market is actually light, which tells me that there is some real selling in the name going on from fundamental investors, as opposed to what we've seen, for example, a few weeks ago when everything was selling off almost to the same extent, and we called it a bit of a quantitative, a bit of a type of electronic, let's call it, selling. This feels a little more discretionary and therefore quite real in the name. Facebook is 5% of NASDAQ in terms of weight, and a lot less in the S&P, of course, but 5% in the NASDAQ, and that's why you're seeing the NASDAQ being affected by almost double than the S&P index.
Some of the other FANG names going down with it as well, and here the fear is that Facebook shining a light on an area that's going to affect them all. Data, our privacy, how it could handcuff them, how the regulators could move in. Some real concerns for the sector going forward, even after perhaps a day or two we shake off some of the more dramatic movements in Facebook?
100%. That's exactly right. Regulation is what everybody is fearing. From my perspective, despite the fact that there might be a period of dislocation as people try to establish what that might mean to these companies, a little regulation on this front is not necessarily a bad thing, as reputation is very important here, and the reputation, frankly, on this front has been a bit of it's been a bit of a problem because what we've heard today in terms of data breaches and how privacy is being measured doesn't surprise anybody. And actually, the fact that it's now more out there, it's probably a step in the right direction. And doing the right thing for investors' privacy is probably the right thing for the companies as well, and the longer term, probably a longer term benefit.
And if doing the right thing isn't enough of a push for Facebook, apparently CEO founder Mark Zuckerberg, with today's sell-off, losing $6 billion in his stock value of Facebook. So that might make you, as the leader of a company, when you're down $6 billion in one day, take notice, make some changes. One would hope.
One would hope, and one would hope that somebody in that company would make a statement. However, I'm sure Mr. Zuckerberg is doing okay.
Okay, he's probably still got a few other billions tucked away, even though he lost $6 billion in one day. My God, these kind of numbers don't even make sense to the average person.
The numbers are outrageous.
Pretty crazy. Let's talk about, another big event this week, or perhaps non-event, depending on how it goes, is the U.S. Federal Reserve. We're going to hear from Mr. Powell. This is his first time they've had a rate decision with him in charge. What's your expectation there? Is he just cut from the same cloth as his predecessors, or could he chart a different course for himself?
That's a really tricky question, because Mr. Powell has already spoken to the House and the Senate a few weeks ago, and market did not take it too well. Now, for those people that are saying, okay, I'm a little anxious because he didn't do too well, and there's a press conference after the FOMC meeting, an FOMC meeting that is almost sure to raise 25 beeps, which probably is in the market. The rates today are not really reacting. So if some people are asking as to whether the market softness is fear ahead of the FOMC, certainly the bond market is not trading as such. And it kind of points to the actual technology stock issues. So in terms of the FOMC, 25 beeps is almost certainly in the cards. We're in a fine balancing act here globally. There's a synchronized global growth phenomenon going on, which is fantastic. Rates are finally in the position where they're able to normalize, which is fantastic and speaks to the market and the economy doing quite well. We've seen it in the earnings. Top line has grown, revenues have grown, earnings have been fantastic. So we're seeing positive things, and so therefore rates are to be normalized. On the flip side, some are perhaps anxious at perhaps 4 is a bit too much or too fast, and everybody's very worried just not to tumble the very gentle balance that so far we still have in the market in terms of where the investments lie. So we've had a big rally and a lot of money that's gone into the bond market, which if the rates go up too much, too fast, and actually it's not even so much the too much, it's more the too fast, as everything is correlated in some way, and we're dependent, the market is dependent on stability because we've had volatility low for so long. So any type of change in correlations too fast tends to topple the gentle house, and we've seen that last month with the quantitative selling as things had to rebalance. So we don't want that. So we want slow and steady Goldilocks.
Over the past 2 weeks, we've had a lot of changing of positions in the White House. In Washington, a lot of turmoil. We had the FBI probe over the Russian influence on the election. Are you getting a sense that politics is still playing a role in the trade, or is it calming down a bit on that front?
You know, if you would have asked me a year ago whether all these changes in government what would it do to the market, I'm sure that we would all have said, oh, that was going to be terrible, and that it was going to impact very strongly. And yet, it hasn't been. Yes, we've had a volatile 30 days, but really not bad since President Trump has been elected. So the impact is less. Maybe the market is a little gotten used to some of the shenanigans that are being positioned in terms of words, less actions, more on words. But bottom line, changes are adrift. I think the market right now is reacting more to earnings and to the rate environment than to the changes in the White House. For the good or for the bad, I don't know why. Perhaps the reaction should be larger, but as of right now, stock markets and companies are reacting to economic changes that so far have been positive, despite the changes at the White House. The tax reform, a potential infrastructure bill, we've seen earnings. So when you strip it down to fundamentals, we haven't seen any anxiety-inducing issues. So market's pricing that in instead.
All right, Diana, always great to get your insight. Thanks for joining us.
Thank you very much.
It's Diana Avigdor, Portfolio Manager and Head of Trading with the Barometer Capital Management.